Kia ora, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock with news. Global inflation pressures seem to be easing off sharply. First, the benchmark for world food commodity prices dropped sharply in July, with major cereal and vegetable oil prices recording double-digit percentage falls. The retreats for cereals are impressive and will certainly ease global inflation. Chinese exports rose 18% in July from a year ago levels, a bit better than expected, but very similar to the June result. Imports rose only 2.3% and less than expected, suggesting their domestic demand is soft, especially as they fell from June. If it wasn't for the US economy firing on all cylinders and drawing in imports from all over, China's trade result wouldn't have held up. In fact, the surplus they reported was a record high. And the Japanese have reported something of a surprise, with household spending rising quite sharply in June to be 3.5% higher than a year ago, up 1.5% from May alone. No analyst saw that coming. Separately, they reported better than expected incomes growth as well. And over the weekend in the US, their non-farm payrolls report for July has heaped pressure on the Fed with a much larger than expected rise. Their labour market remains hot, with employers adding 528,000 jobs in the month, double what analysts had expected. This is not data that suggests the US is in recession. July is normally a month when overall payrolls shrink as firms go into their summer shutdown mode. But this year that hasn't happened, with the employed labour force now over 152 million workers and a hugely impressive 5.8 million gain from a year ago. Meanwhile, American consumer debt rose more than expected, in fact up $40 billion in June from May, and that was almost double the $25 billion expected. And the May rise was revised up. The June rise was the second biggest jump ever. Singaporean retail sales fell in June from May, and that undermined their good year-on-year gains. Apart from fuel sales, which were boosted by inflation, the falls were widespread and somewhat unusual for them. If the Chinese posturing on Taiwan is extended, that probably won't help economies like Singapore. In India, their central bank reviewed their policy rate late on Friday. It was 4.9%, and markets had expected a 35 basis point rise to 5.25%. But the RBI pushed through a full 50 basis point hike to 5.4%. It's a sharper than expected rise because they too have inflation concerns, and they need to shield their exchange rate, which has come under pressure since the war broke out in Europe. The US Treasury 10-year yield starts today at 2.83%, jerked higher by 16 basis points on the US job data. And the price of gold will open today at $1,776 an ounce, which is up $2 from this time on Saturday. And oil prices start down a mere 50 cents a barrel from Saturday at just on $88 a barrel in the US, while international Brent prices now at $94 a barrel. A week ago, these prices were $98 and $104 respectively, so basically a drop of $10 a barrel in that time. That's a drop of 22% from early June, and basically back to prices in effect before the Russian invasion of Ukraine. The Kiwi dollar will open today at 62.4 US cents, which is a 0.5% lower than this time last week. Against the Australian dollar, we're marginally firmer at 90.4 Australian cents. Against the euro, we're also firmer too at 61.4 euro cents. That all means our trade-weighted index starts today at just on 71, and it's been about in a tight range about that level for about 3 weeks now. Get more news affecting the economy in New Zealand from